Hi there, it is Stephanie. This week I'm back to share a bit more information about some just research and digging I've done this week on the oil industry, specifically oil and gas. And so I have a couple of things I want to chat through today. Yeah, let me just sort of go ahead and get started. So, and the first question might be why oil, right? I think over this past year, there's been a lot of ruckus and a lot of just momentum going towards the renewables space as we focused a lot more on, climate change and those concerns and stuff like that. And so oil in some ways, I mean, I guess now, with where we're at, having been a year now past COVID, has, I think recovered from some of its like very low lows, but still in some ways I would say is a pretty unfashionable sector to be in right now, just relatively speaking. And so oil in some ways is not the most, I guess, let's just say it's not, I guess, your first pick if you were to, think about companies you might want to invest in. But for me, I guess the reason why I've been interested in looking at this is because I've just been doing a bunch of reading, listening to podcasts from different industry experts and folks. And I think there's a couple of different so yes, while there has been a lot of ruckus and commotion around renewable energy and just a lot of investor interest in that sector, I've been reading a bunch from some folks that have, in some ways, I guess, not debunked necessarily, but I think have sort of reality checked some of the different claims and some of the clamoring, I guess, that a lot of different governments, companies have been talking about when it comes to the energy transition. So I'm actually reading a book right now from this Professor Smil. He has actually a whole number of different books about energy transition and just different books about energy. I'm reading a book right now called, I think, Energy Myths and something. Oh, I wish I remembered. But basically, in a lot of what he's saying in his writing is sort of just providing more historical, data driven takes on energy transitions in the past, what it typically takes, how much time it typically takes, and just kind of has been an interesting resource just to gut check some of the claims that have been made. So I just found this. I've been reading the book, which is actually super interesting and actually provides a lot more detail if you want to learn more. Actually, let me just see if I can look it up. Smil Energy Myths and Realities, that's what it's called. Yeah, so it has like basically in the book, they actually talk about. Can I see the sections? He basically talks through like a couple of different myths and that are kind of like around the area of like energy transition and kind of just provides a bit more context on it. Okay, maybe I can't see the chapters here. But anyway, it is a super interesting book if you want to learn more. Like, there's a chapter on nuclear, there's a chapter on wind, there's a chapter on like the pace of energy transitions, which is the one I'm reading right now. But basically, I think there's a couple of different fact checks. One, I think, is basically realizing that the pace of energy transition is much faster than than probably the attention span of like investor fads, basically. Like he points out here, let's see. He took so when it actually let me go talk about this. So when it comes to energy transition, for those that aren't super familiar with energy, there's been a couple of different phases that have already happened. So I guess way back when, let's say like 200 years ago, for the most part, we used traditional biomass. I guess that's things like wood, like just like natural things you would like find out and about, and then I guess like pretty early on, we started discovering. Actually, can I? How do I unselect this? We started discovering fossil fuels. So first it was coal, right? You know, these really condensed pieces of hydrocarbons that have all this energy stored in them. So we used coal first, and then over time we eventually switched over to oil, which is another type of fossil fuel. And then now on top of that we also have why can I not? And then on top of that now we have gas as well. And so there's been a couple of different energy transitions. I guess I would say there have been two major ones so far, right? From biomass over to coal, right? As you can see over this time horizon, and then from coal after coal, coal I think right now Still, of course, like a pretty decent part of our energy breakdown. It's like 1/4, 25%. But oil has become, like, for example, a much larger percentage. So there's also been a sort of smaller ongoing transition over to oil. And gas as well. And then on top of that, you can see all these items up here are basically all the different renewables. So it's, I think the red is nuclear, then the next is the hydropower is the blue one, and then wind. Yeah, wind is the green one, and so on and so forth. So as you can see, right, just even looking at the slope of these charts, energy transition takes a long time, right? Yes, we've heard all these different government and, like, company promises that, like, yes, we want to lower emissions by X% in the next, 10 years, 15 years, but realistically, it will take, massive large scale transitions of energy to do that in order to achieve those emission goals. And as you can see here, right, like even just looking at coal, right, with the first energy transition, it took, I think, about 100 years. Let's see, 100, yeah, nearly almost 100 years, basically, from, let's say, 1800 to 1900, for coal to get to, like, almost around 50%. And then if you look at oil, it was like, let's say, a couple percent here, like 3% back in the early 1900s. And I think at its peak, oil gets to like 40% ish. And that's like 60 years later. So I think the point I just want to take away from all this is just to comment that, we're talking on the order probably of decades here, right? And that's assuming that, everything continues to go in this favor. We don't, for whatever reason, start to turn back to fossil fuels or something. But I think that's just a good gut check for us, to when we're thinking about, the oil and gas sector and how relevant or not relevant it's going to be in the sort of short to medium term future. So yeah, just wanted to call that out. Is there anything else I want to say about this? So yeah, it took the U.S. 25 years to go from 5 to 25% oil. 25 years, okay. For natural gas, it took 33 years. And after crude oil reached 5% of global energy supply, it took another 40 years to get to 25%. And for natural gas globally, it was even 55 years. So I think the other thing to note here is that with each subsequent, energy transition that happens, it takes longer and longer. And that kind of makes sense, right? Because no longer you have like this incumbent energy source that you're competing against, whether it's coal, whether it's oil. And so renewables, right? Like, because we already have, so this is slightly different depending on what country you're talking about, but if, like for really developed countries like the US or, the Europe or whatever else, you have all this existing infrastructure that's been built up around things like coal, things like oil, like, all these different companies, the different mines and the places where they're actually drilling and sort of mining these different materials, refining it and all this stuff. And it is going to, replacing all of that is going to take, the barrier to actually displacing all of these existing incumbents is just higher over time because you have all these other sources that you're competing against. So the other thing I want to call out here was this last item here, which is not only, do they take into account the fact that the energy transition is quite slow, but we also then take into account the fact that our the current fossil fuels that we're using, yes, there's, crap tons of emissions and it's not great for a lot of environmental reasons. But one thing it does have going in its favor is that it is extremely energy and power dense. And that's important, right? When we have things like urbanization, industrialization, where we don't really have a lot of space to produce energy, and we need and ultimately right now the way our world is structured is that it kind of relies almost on these very energy dense materials. And so if even if there's a lot of political and and just a lot of will in general to transition over to renewables, there's just like the fact of the matter that renewables have a much lower energy density, and the demand for power is only going to go up over time, and so we have to figure out basically how we kind of square that circle. So just to kind of provide some concrete details, I remember I was listening to like a really like some podcasts where they talked about it in a more concise way, but I just dug up this chart online that sort of just gives an illustration really quickly, right, of like for each different type of energy source, what is the energy density of that source. So as you can see, solar, geothermal, so that's like heat, heat basically in like heat and stuff like that. You've got wind, you've got I'm guessing tidal water, is that hydro? I'm not quite sure. But as you can see, all these renewable sources, right, have a much lower energy density when you compare it to something like oil or gas. And even natural gas. And so I think that is something that we have to consider, right? When it comes to when it comes to the energy transition and renewables, how likely is it and how fast is it going to actually become more of a thing? So anyway, I think that's all I want to say basically about why oil. So that's basically why I started looking at oil. And yeah, so okay, so that's that. Next item I wanted to chat about, okay, so just like some specifics when it comes to this specific sector that we have to take into account. Of course, when it comes to oil and gas, so there's different types of companies out there, right? And oil and gas definitely falls into the category of being very driven by commodity cycles, right? So if we just look at the price of crude and of oil over the years, right? So this is a chart, I guess, basically from 1950 all the way up until now. As you can see, there have been times where it's been really low, right? Like, maybe when it wasn't used as much. There's been like small moments, right, where it's been very cheap, like last year, like back in 1999. But then there's also been periods where it's been extremely high, right? So it's been on the order of, so this is a price per barrel, I believe. Yeah, price per barrel. I believe a barrel is like 40 some 30 something, 40 something gallons. I forget. But basically, what's it? Yeah, so there's been periods where it's been really low, there's been periods where it's been really high, and there's been just like different times in between. So that is something that, when it comes to actually valuing and looking at different companies, of course, for companies that, are in these like oil and gas sectors, you really have to take into account just like the fact that there is very much so boom and bust tendencies, and factor that into your valuations, and also in your valuation technique. So yeah, that's what I wanted to point out here. Growth tendency. That's more from the context of like, so for example, when we're talking about, I don't know, like a standard company, like, I don't know, a software company or a food company or whatever else, for the most part, in a lot of these cases, you can kind of just assume like, near, like, depending on what industry it's in, you can assume almost like constant growth, usually in like the upward direction, right? So like software company, yeah, we assume that most of them will, continue to find more users and more revenue over time. When it comes to food, it's like, okay, yeah, it might not grow as fast, but we expect that generally to trend up over time as the population grows and stuff like that. When it comes to oil, though, and I guess just generally like commodity companies, you can't really assume that, right? Because as we can see, right, there have been times where the price of oil is like $130, and then, what's it? I can't, math. Like, is this 10 years later? This would be 10 years, like slightly less than 10 years later, it has fallen down to like, I don't know, like $40, which is like a decrease by 2/3. So of course, when it comes to looking at these companies, you are going to see fluctuations. And so that's where, that's just like mentally, that's something you kind of have to just like keep in mind when you're looking at these companies. So yeah, okay. So we talked about why, we talked about the commodity cycle. So next, I want to chat a little bit about valuation, just like methodologies here, because as we mentioned, right, there are all these boom and bust cycles. How do you actually do a valuation, forecast future cash flows and stuff like that when, it is so all over the place, right? It could be as high as like $130, it can be as low as like, I don't know, $20. And so there are a couple of different, so this is where so Professor Damodaran, of course, in his textbook, and I guess also here, he just has it available online if you want to read it, but has a chapter on valuing cyclical and commodity companies. And so it's actually pretty, I actually end up reading the whole thing. It is actually quite helpful just to think about just different ways that, different things you have to take into account when you're valuing these companies. But I will summarize just like some of the high level approaches, which I've listed here. So there's a couple of different ways. So just to recap, okay. and chat through this really quickly. Typically, right, when we run through, actually, let me pull up another example. Let's just go Alibaba, which I did before. Typically, when we look at a company, right, it's like we look at the historical numbers. And when we look into the future, right, we'll try and estimate out, okay, here are what the revenues here's how the revenues might grow. Here's how I think the margins might change. And because of that, here is what my earnings will look like in X number of years. Unfortunately, when it comes to cyclical and commodity companies, you can't always do that because of that fluctuation that I talked about. And so, and also the valuation that you do can also be, and the numbers you ultimately get can really be dependent, right, on where you are in the cycle. Because, like, for example, if I valued a company, an oil and gas company, when the price was up here, right, and their numbers look great because oil is $100 a gallon, or sorry, $100 a barrel, it is likely going to be an overvaluation if I assume that, okay, this is the kind of pace that I'm going to be working at forever, because as you can see, quite shortly the price of oil basically halved. And so depending on where you are in the cycle, like, you can end up with drastically different numbers. You can undervalue a company probably if you value it down here, but you can also overvalue a company if it's too high. And so there's a couple of different methods that he's talked about. So one is you can normalize basically the numbers you're looking at. So, like, for example, just looking at let's look at Exxon to start with. So looking just to kind of describe what's happening here. So here's what the revenues look like for the last 10 years. I also put the average price of oil for that year on the side so we can compare. But as you can see, so one thing you can do that he brings up as his first option is that you can actually try to normalize the data that you're looking at. So this works, I guess, a bit better for Professor Damodaran's spreadsheet. Let me just pull that up again, because he just looks at, when he powers his spreadsheet, where is it? He just looks like the last 2 years worth of data. So I guess what you would do in this case is you might average, like, okay, the last 5 years worth of data, and put that here versus, like, maybe the last 5 years before that or something like that. Or like offset it by a little bit. So that's one thing you could do, which will hopefully normalize, some of the numbers that you see, because hopefully with that, you then capture times when it's high and you also capture times when it's low, and it kind of averages out. So that's one technique. I didn't end up doing that, but that's one thing you can do. Another thing you can do, which sounds kind of fancy, is he talks about basically, so this is the technique I'll be doing in my evaluation, so we can kind of go through it more in detail later. But basically what's happening here, what you do with this technique is you actually try to see if you can find a relationship between these prices and either the revenue or the earnings of that company. And so if you can try and figure out a relationship, right, between the oil price and the earnings or the revenue, you can just make that into a formula, and then you can plug in a certain number to figure out, okay, let's say if I know that the relationship between the oil price and the earnings number is like, some factor of X, what I can do is I can plug in X being, let's say, my oil price, and I get like what the resulting value might be, which is how much I think earnings might be if the oil price is like $50, for example. So that's kind of confusing. I'll chat through this later, and we can talk through a concrete example, but basically this allows you then to kind of just try and forecast out what some of these numbers might look like, depending on what the oil price is. So you basically have like this variable, and then you have some kind of result that comes from it. So, anyway, so that's the second technique. And then the third technique is kind of basically, maybe it's the most simple in some ways. Basically what I think he's saying in this last technique is, so instead of like doing the technique I talked about where you try to like forecast out what the numbers look like, you would actually just like, for example, that's kind of what I did for this other side. So what you can do is you can try and just adjust your growth rates to account for the fact that it's cyclical. So instead of like, right, looking at Alibaba, where for the most part my numbers are very positive, right? It's like, okay, for the most part, assume that they're just it's just generally going to mostly go up over time. Instead, and it's consistently like positive, right? Instead, what I do for this is that I kind of just build in the fact that it is going to dip, it's going to go down, it's going to go up, and you basically try to just kind of forecast out what you think that's going to look like. Of course, with this, like, you're introducing, there's a lot of assumptions you're making, right? Because you're assuming it's going to play out in a certain way and it might not. But that's basically another thing you can do to try and forecast out what this might look like. So 3 different ways that you can try and come up with a valuation. Another thing, just to sort of throw that out there, this isn't, so in addition to what I just mentioned, another thing you also probably want to do is, given that there's so much uncertainty, right, about where the price of oil could be in the future, another thing he suggests is to look at different variations of the future. So scenario analysis is basically playing out the scenario of, you basically you set a couple of different scenarios, right? So what if the price of oil is very low? What if the price of oil is like kind of at an average point? And what if the price of oil is really high? And you figure out what your valuations look like, given, all 3 different scenarios. And then simulations is it's a slightly more advanced version of that. But basically, does he have an example? I think he's an example of this. This is probably where you also need like additional software to implement it. But basically what he does is he creates a distribution of like, okay, in the future, right, it is very uncertain. I don't know what the price of oil is going to be, but I think it will kind of look like this, where I think on average, like looking at this chart, it's basically saying, I think it will mostly be, on average, probably closer to like $40. And there's a small likelihood it will go very high. And, there's a decent amount of likelihood that it could go lower, but you basically create some kind of distribution for what you think the oil price is going to be. And then after that, it's basically like doing scenario analysis, but on steroids, because you just run like 1,000 or 10,000 simulations, assuming the price is here, assuming the price is somewhere else. And taking into account this probability, you basically kind of run through these simulations, and basically I think it just kind of averages out and gives you a number at the end of, given this particular distribution of what the world looks like, here's what I think your company might be worth. And so scenario analysis is kind of like doing the same thing, but you're basically just choosing 3 different points on this as opposed to this, which is very continuous. So yeah, if you want to do this, basically I believe you would want to use some kind of Monte Carlo software to simulate this, but for the sake of simplicity, I don't have that set up, so we're just going to skip that for now. Okay, so we talked about methodology. Check. Okay, second to lastly, we're now actually going to go through, actually, is there anything else? Okay, that's all I want to talk about for that now. So now I'm going to actually talk and run through 5 different, another sort of primer about oil and gas for those that aren't familiar. When it comes to, I don't think I actually have something, 7 Supermajors oil. When it comes to the oil industry, so the industry is kind of split up in different ways. Here is this link that I found to be quite helpful. So it's actually this random like financial modeling site that I found in oil and gas. It has a pretty helpful primer about just like the structure of oil and gas companies. And then also if you want to do a more intense forecasting basically and sort of analysis of the spreadsheets, it has a lot of really great information about oil specific considerations when it comes to like analyzing oil companies. So if you want to check that out, feel free to. But the piece I wanted to focus on here was, just talking about the different ways that the companies or the different, the way the industry is structured. So you have, when it comes to oil and gas, basically they've got upstream, midstream, downstream, and the way that's sort of split out is you've got, like, for example, it basically corresponds to different parts of the value chain. So at the very top of the process, you have exploration and production companies. They basically are responsible for finding and extracting the actual oil or coal or I'm not sure if this applies to coal, but at least oil and gas, finding and extracting those. Then you've got midstream companies that basically focus on transportation, right? So pipelines and stuff like that to get it from point A where it gets, where the material comes out to the point where it actually gets refined, which is the downstream part. So downstream is basically like refining the actual raw materials, and then also marketing, which is selling it basically. So like, for example, Exxon Mobil has gas stations, right? So basically all the revenue that they get from, both refining it and then also selling it to end consumers. So that's downstream. I think a bunch of these other companies have something on the side, which is called, I don't think it's usually, sometimes I think it might be lumped up in downstream, but you also have chemicals. So petroleum and oil actually helps produce a bunch, or actually is like the feedstock, or like basically the raw ingredient to create different chemicals. And so a lot of these companies also have like a chemicals division where they actually create chemicals as well. But outside of that, you also have oil field service companies. We're not going to talk about that today, but basically they help provide different services, tools, software for these companies to actually run. So these are companies like Halliburton, Schlumberger, companies like that. And then today we're actually talking about the integrated majors. So these are companies that basically have upstream and downstream, and then some other related companies. And so, yeah, so that's that. There are, I think when it comes to, that's not the one I want to look at. So yeah, super majors, there's a couple of different integrated majors. So we're going to be talking about today BP, Chevron, Exxon, Royal Dutch Shell, and Total. ConocoPhillips, I believe, is not integrated. They just focus, I believe, on upstream, and ENI. I did not end up running because I couldn't get the numbers to work. But yeah, basically we'll be talking about these major 5 companies today. And yeah, okay, that's all I wanted to say about that. Okay, so we will start out with Exxon. So I don't have a super concrete plan for this. Let me just sort of talk through it. It might be a bit scattered, so excuse me now. But okay, we're gonna start out with Exxon. So what do I want to put out here? As you can see, just starting out from the top, as we recall, right, this information up here is basically the historical trend for the company. I've included the oil price here for comparison, so we have a sense of what the company operates like when it is, at a high oil price, which is on the order of like $100, how it operates when it's at a low price, right, so like kind of 50 or under, and then what it kind of operates at when it's at sort of like an average oil price of like around $60. So as you can see, right, the revenue of the company, typically for most other companies, this is usually just growing upward. But as you can see, the revenue for Exxon is basically halved, if not actually more than halved, basically in these past 10 years, because as you can see, the price of oil has fluctuated quite a lot. And so yeah, that's revenue. It's definitely going down. EBITDA, as you can see, it's gone down by more than 4x basically, because we were almost at 90 and we're now at 19. So as you can see, it's kind of fluctuating a lot. If you look at the EBITDA growth numbers, like there's a lot of years where it's negative. There's some years where it is positive. So that's something we'll have to take into account. So debt is kind of like a big thing for a lot of these companies because, of course, when it comes to working in physical, mines and upstream work and stuff like that, there's a lot of CapEx that you have to spend. So a lot of these companies end up taking on debt to kind of try and, mitigate the cost of needing so much capital to fund their operations. So as you can see, it's grown quite a bit. I guess it's gone up like around 5x-ish over the last 10 years. But in general, their net debt to EBITDA ratio has actually been not horrible. So just to remind people again, so net debt to EBITDA basically is the number of years that it takes to pay off debt. That's the metric that in this framework we use to measure how much debt a company has, and generally the threshold that we look for is something under 3x. So the idea being that it will take, an acceptable number is to have basically 3x worth of earnings to pay off your debt. And the reason we use that, I believe, is because that's typically the ratio that banks will give you. They'll allow you to leverage yourself up to 3x your earnings. So that's sort of what we want to stay under. So as you can see, right, net debt has actually stayed like relatively okay. It's been basically under 1 for the majority of their existence. Right now it's quite high because, of course, like EBITDA is quite low because, of course, last year was horrific, right? It was around $40 average per barrel. But yeah, so that's that. The multiple EV over EBITDA on average has been around 8x, so that's something we'll want to just keep in mind. And then looking at the cash flow, that's another thing I want to point out here. So as you can see, they have what's the word? So the cash flow has, gone down over time, sort of consistent with EBITDA, although the rate has been slightly less. So in general, we want this to kind of be in line with what the EBITDA rate is, but it looks like it's, not quite as negative relative to EBITDA. And then when it comes to CapEx, right? So just looking at it, it was so typically patterns wise, right? We expect CapEx to be quite high, probably when the oil price is high because they have a lot of money. And then we expect it generally to slim down if the company is a good company over time when they actually are making less in revenue. And so do we see that here? Let's see. So it was high. So basically high from, the first 3 years, that kind of makes sense. Then the next 3 years from 15 to 17, looks like, they were able to bring that down. And then last year, they were also able to bring it down quite a bit, when the price of oil tanked. So in general, that's pretty good to see. Yeah. And so another thing to point out here is that, so the return on invested capital, right? So this is basically telling us for, each dollar, for example, that goes into, investing in this company, whether it's debt, whether it's equity, what is the actual return that you get? So how efficient are they at actually, giving you a return on your money? And so, of course, unsurprisingly, when the oil price is really high, we had really high ROIC. And then, of course, when it's been lower over time, right? So in like this range, it's been quite low. And even, over the last year, it was even negative. So that's sort of, I guess, something just to kind of keep in mind with the nature of this kind of company. So, okay, so then that's historical. So typically, right, how we would value these companies is we would typically try to forecast out, okay, here's how the revenue is going to grow, here's what my margin's going to be, and you get from that like some kind of forecast to EBITDA, and we use that to come up with our valuation. Instead, just to reiterate, we are going to go with, this approach here. So we're going to try and predict a price based off of different oil prices. So how do we do that? This is where, okay, here to explain what is happening here. What I have done is I basically pulled all of the historical data that I could find using the sort of data source that I'm using, which is Financial Modeling Prep. I basically tried to pull for Exxon, right? What has their EBITDA been for the past, 20, 30 years? And from that, I also I also pulled the average oil price of, for, that same last 30 years. And what I did was I charted that onto this chart. So each point here is basically each pair. And what you can do in Excel, in this case, Google Sheets, is you can actually, so this is a process called creating like a linear regression. And this is actually relatively not new to me, but basically what you're trying to do when you do a linear regression is you basically have all these different points, and you basically, when you do the regression, you're just trying to find a line that tries to best match the pattern of these different dots. So as you can see, there's like, roughly speaking, it's like kind of going that direction, because like as the price goes up, you can see EBITDA goes up. So you can see there's some sort of relationship there. And so basically this line tries to represent, okay, here is on average what I think the relationship. So this is when I go back to talking about like, what is the relationship between the oil price and EBITDA? This line basically tells us what that relationship is. And this is the formula. So for those of you that remember, I don't even remember what type of math this is. I don't know, lines. Basically, so how you actually create the formula for a line is you have some kind of coefficient. Yeah, you have some kind of coefficient. So usually the slope, so the formula for a line is typically the structure of like y equals, is it mx plus b? I forget the exact names of the coefficients, but basically what that means is so m is basically what is the slope of this line, right? So is it really steep? Is it not so steep? And then b is your intercept. So b is basically on this y-axis here, right? Where is the point at which when x is 0, where is y, and where is that on this axis? So this this Google Sheets formula, thankfully, gives us, given, this pattern of the scatter plot of different earnings prices and oil prices, here's what the relationship looks like. So basically, that's sort of trying to describe what that relationship looks like. And then this R squared number is basically this fancy way of, basically it tells us how much does this line actually account for like this actual pattern that you're seeing. And so as you can see, so it's a percentage typically. So in this case, it's around 42%. And so that basically means that this relationship between this line that we've created, this formula for this line we've come up with, basically explains what's happening here 42% of the time, if that makes any sense. So roughly speaking, that's actually not super high, right? Because that means that over 50% of this relationship is driven by something else. So it's not great, but we're just going to work with it because that's what we have. All the other ones I'll talk through have an example of this, so we'll kind of chat through what that looks like for those if you want to compare. But basically what we do with this formula once we have it is we use it to calculate what the EBITDA forecast is. Because when it comes to, using this, what we actually do is basically in this case, X equals to the oil price. So this is like the independent variable, and Y is equal to the EBITDA forecast, right? So basically what we do is we plug in some value X, right? So we can say, we can use 20, we can use 30, we can use 40, whatever. And once we plug that in, so we know what X is, we multiply X, if it's $20 times M, which in this case is 762, and we add that to the B number, which is, just over 12,000. So what we do, so basically we plug in this number, we plug in X, and we basically get Y. So that's basically what's happening here, right? This is X and this is Y. I will just put on the side so we can see. So that's what I'm doing here. So I've said for every $10 from $20 to $150, what do I think the EBITDA number will look like given this relationship? So that's basically what I use. So that's the first place that I want to start with. And then once we have that, if we remember how we do, the valuations, what we typically do is, just to bring up Alibaba again, what I typically do is, we figure out what the forecast looks like, right? So this is this is the EBITDA forecast. I punch it here. And what I do is I take the EBITDA number in the very last year, so 2030, and then I multiply that out times my multiple to get my enterprise value. So in this case, it actually doesn't matter what the interim EBITDA numbers are. I just care about what the end number is. And so what I do after that is I basically come up with 3 different scenarios. So doing that scenario analysis we talked about before, I come up with 3 scenarios. I have a low, a medium, and a high price for 2030. For now, just for my own valuation, I'm using $40 as low, I'm using $60 as medium, and I'm using $100 in the future. That is based off of just looking at, just like eyeballing this chart. I was kind of like, okay, looks like low is kind of like around here, right? In more modern times, this is probably low from before. Low recently, it's kind of looked like it's hovered around $40, right? This here looks like kind of a good midpoint, right? So this is like around $60. And then up here, like it kind of fluctuates, but it looks like it's been as high as like $130, $100. I generally just decide to cap that at around $100 because I figure, oil is in some ways a somewhat doomed industry. So I'm not going to probably give them that much credit for like having a really high number in the future. So that's what I use. So what I did is I pulled, looking at our forecast, I pulled, okay, this is what our $40 price looks like, this is what our $60 price looks like, and this is what our $100 price looks like. The other thing I just want to note is, okay, one small detail. Outside of the formula that I just applied, I also, given that this is going to be 10 years into the future, I also adjust for inflation. So this is what this piece is. Basically, I'm assuming that there's going to be 2% inflation. So this like value is going to grow every year by 0.02 basically, and I multiply that out by 10 years because I'm looking 10 years into the future. So that's something I just take into account so I can make sure that this number is not in today's dollars but is in $20-$30. So okay, so what I've done is I pulled those numbers here. That looks good. And so yeah, so that's basically what we need for the EBITDA valuation, right? The sort of earnings driven valuation. I take these numbers of what I think EBITDA will look like in 2030, both high, medium, and low. I multiply that out times the multiple. In this case, I just use the average, which is around 8-ish. And then debt, I believe I just use 1x debt because that's sort of historically what it seems like they've done. And so with that, right, enterprise value, we get market cap from that by taking enterprise value, we take out debt, we add back cash. I had no idea how I wanted to model cash, I just left it out. So it gives me a market cap of just over $500 billion in 10 years. Excuse me. So that's market cap. I then divide that out by the number of shares. I think, yeah, I just take the last number. If you want, I guess, if you want to be super thorough, one thing to take into account is the fact that this actually has gone down over time, right? We've kind of gone from 4,800 to 4,200. So if you want to kind of be a bit more realistic about it, you could try and carry that forward and assume, okay, assuming that the number of shares is going down X% a year, like forecast out for, the next 10 years, where do I think I might be, which is probably some degree lower than 4,200, but for now, whatever. So we take this, we divide that by the number of shares, we get the price per share in 2030. So that's one price. That's one way that we get the valuation. And okay, then pivoting over to the other valuation technique that we typically do for this, which is looking at the free cash flow to equity and then coming up with a valuation from a cash flow perspective. So in this case, this technique is more so following the other technique he mentioned, which is adjusting growth rates, right? So what I did here was, okay, so one note is I decided not to use last year's because last year's, of course, was, I think, negative. Was it negative? Last year it was positive, but it was a bit of a strange year. So I didn't want to use that as my baseline because on one hand, like CFO is really depressed, CapEx is quite depressed. And on top of that, they also issued a lot of debt. So I thought this number was a bit skewed. I didn't want to use that as my baseline. So I decided to use the year before as my baseline. So 331. And then, okay, this is like, there's a lot of like fudgery that happens on here. This is where it's very up for like interpretation, how you think it might play out. But basically, I think the way I tried to think about this was I want to factor in, make sure that I represented the cyclical nature, right? And in this case, basically, I think I just tried to factor in like 2 different cycles that might happen, which seems, I don't know, like fairly plausible given that like over the past 10 years, 20 years, we've gone through like 3 different price shocks. So actually, wait, no. Just in the last 10 years, we've gone through 2 different price shocks, right? So 2 different cycles. Here's when it dropped. And then once again, it dropped in 2015 and then also dropped once again in, of course, last year. And so I figured, okay, 2 different cycles. Let's try and factor that in. So what I did here was I tried to understand, okay, given the historical, patterns in the last 10 years, how has their free cash flow to equity changed in different phases of the cycle? So, how has it changed in high points of the cycle? How has it changed in low points of the cycle? Keeping in mind that like when things go negative, some of the percentages get kind of weird. So that's something just to take into account. But basically, so I think looking just into the immediate sort of like short to medium term. So I assume, okay, this year we're reopening up, it's going to grow, a decent amount. So it's going to be, 20%. But, take into account the fact that like there's still going to be a bunch of economies that are not fully opened yet, right? Because just looking at where we are now, we're already in May. We're already in May, and yes, we see some signs of reopening from some countries, but there's a lot of countries that are still pretty locked down. So I figure, okay, this year we're going to grow. We're not going to grow by, a crazy amount, but, in the next, but I think we'll probably be mostly resolved for at least some of the major companies that will get this, some of the major countries that will get this under control. So for the next 2 years, I basically have it growing by 25%. And then over time, I sort of see, I forget. I think I made this just go down because I wanted it to have 2 different cycles, but I had that just drop down over time. And then I kind of like repeated the same process almost going forward to the future, but take into account the fact that I think growth is going to slow into the future. So yeah, this is where you might want to just like, you can come up with your own bright percentages here. Another thing I will say, just to keep in mind, we'll kind of talk through this as we compare other companies, but like some company, it seems like in this case, right? In general, it seems like on average, their free cash flow to equity is always like positive. So I do have it fluctuating, but mostly I keep it positive because that's sort of historically what I've seen here. But as you can see for other companies, it's not always going to be the case. So that's something you just kind of want to sanity check to see if like, can I see this being like a plausible future given what has happened in the past? Okay, so yeah, that's free cash flow to equity. And so what we do, of course, with that is we take that, we punch that over here. This is my forecasted numbers for the next 10 years. And what I do is I take the last free cash flow to equity number, I multiply that out times a yield, right? So I think I just used the average in this case, which is 5%. And if I multiply those together, I get a price back. I'm actually probably going to adjust this to be 75 because I feel very iffy. Like, even though there's so much like fudgery going on here, I'm actually, both sides are kind of fudgery because actually I'll change it back to 50. Because my R squared number here is so low, I don't know if I feel that trustful of these forecasts. So I'm equally uncertain about both. So we'll just leave it at 50. So of course, just to remind people again, what we do here is that we take, given the weight, we basically average out these two different prices. We get some average price back. And that gives me a market cap, a weighted market cap of basically $423 billion, $3 billion, which is a 1.6x point from where we are now, which is 266 billion. So, okay, just to kind of finish this out, so historically, right, what we do also is we actually also look at the IRR calculation, given that, if we're going to be investing for 10 years, what is our rate of return if, we invest X number of dollars, and what will that give us in 10 years? So what we do is we take the free cash flow forecast, we take into account what I can get in for right now, which is $63 as of today, which is May 7th. And what do I think, how am I going to exit in 2030, which, I forecast it to be $99. With this view, that gives us an IRR basically of 13% over the next, every year for basically the next 10 years. So of course, just to remind people again, we have this sort of distribution at the bottom. So if the price goes down, if it goes up from where it is now, here's how your IRR might change. So if it drops basically by 33%, so it drops by a third to $41, you'll get an IRR, assuming, of like you believe in the forecast, you'll get an IRR of 21%. And if it goes up by, a third to $82, your IRR becomes 8%. So, yeah, one last thing I also want to call out here was I did a like very quick and dirty DCF basically. So for those that remember, right, a DCF is basically you look at all the cash flows into the future and you basically come up with a current day valuation by discounting these future cash flows by some discount rate. And the reason, remember, that we discount it is because the future is uncertain, right? So you can't the future is uncertain, so you can't, even though I think it might be like, $6 in like 3 years, the likelihood that might happen, there's a lot of uncertainty that can happen. And so I should discount, even though I think it might be 621, I should discount it to adjust for the fact that there's a likelihood that it could be lower than that. And there's a likelihood it could be higher than that. And so for those that remember, I don't think I have the diagram handy, but for those that remember, as we go forward in time, we basically discount it more. So looking out for a year, we discounted by like some X%. And then discounting it 2 years into the future, I discount it twice basically because I discount it for 1 year and I discount that again for another year. So as we go out further, you discount it even more. And for those that remember from way back when, historically, typically, what you want to use as your discount rate, I forget the reason why. I really should look this up, but you discount it typically by the cost of capital. And yeah, I really cannot recall why that is, but for whatever reason you do. I grabbed this from the Morningstar report because they mentioned in their forecast like what they use. So I just copied them. They are apparently in their valuation, they're using around a 7% average cost of capital. So what I did was I took all these numbers, I discounted it in this row. So as you can see, this this first year I just discounted by 6.9% once, and then going forward into the future, I discount it by 2 basically, because yeah, anyway, this is supposed to represent the 2021 number. This is the 2022 number. So I discount it basically by 6.9% squared. And so basically this is how you can, so as you can see, right, then it takes me down from nearly $4 this year to basically $3.72. And going forward into the future, it basically discounts it from almost $4 to like $2. So it's just a really quick and dirty version of doing a DCF. But basically that's trying to say, assuming these numbers are correct, which they probably are not, here's what I think, given this forecast, this is what I think this number would be worth today. This is what I think the company would be worth today. So $34 compared to $62. So take with a grain of salt, like there's a lot that is, sort of up in the air with this, but just interesting numbers to kind of compare against. I think, okay, 2 more things I want to point out, which is one, another thing I tried to do just to kind of contextualize the current valuation for me is, so when it comes to cyclical companies, right, like they tend to kind of go up and down. And as you can see with like Exxon, actually it's kind of hard to tell, but so this is maybe something we can kind of validate by looking at like their production numbers and how that's trended over time. Because let's say, like, assuming that the numbers have kind of been consistent over time, like let's say, yeah, in the last couple of years, not grown quite a lot. For the most part, you would kind of expect like the fluctuation to, like, unless the company is like growing production by a lot, which would kind of skew the numbers, we would kind of expect like the market cap to kind of like exist in a certain range, right? So, when it's high, it's going to be at a certain price. When it's low, it's going to be a certain price, assuming that, right, the sort of like number of the amount of inventory, the amount of stuff you're selling stays relatively constant. So taking that into account, what I did was I tried to actually just chart out what does the market cap changed, how has that changed over time for the last 10 years. And I actually took the average market cap to figure out, okay, where is that sort of midpoint? And against that, I charted, okay, what is the current market cap and what percent is that current market cap of the average market cap? And what that tells, like, so just like interpreting all this, what this tells me is, in general, I assume, this like Exxon to be on the high side, right, when it's closer to like just over 400 billion, and it's on the low side, right, like I guess last year was a good example where it went all the way down to like 200, which is like basically half. And right now where we're at 266, so we're kind of like somewhere around here, right? So what that tells me is that on average, when it comes to like the general oil cycle, we're still relatively, we're not the trough anymore, we're kind of beyond that part, but we're definitely nowhere near the tops. And so if it comes to looking at the cycle, we're basically probably somewhere at the beginning, like we're probably like, I don't know, we're kind of somewhere maybe like here-ish, where it's like, okay, it's not quite the low point, but we're recovering, but we haven't sort of, like, there's still quite amount of sort of space to go before we even think about reaching a top. So some interesting context there that, definitely take a certain number of things into consideration. Like, you're making a number of different assumptions, but something to think about and incorporate. And another thing that I decided to do just for my own like curiosity was just to kind of understand what the breakdown of revenue looked like across the different revenue streams. So as we talked about, right, you've got upstream where you're basically mining and finding all the different raw materials. You've got downstream, which is for a lot of these companies the bulk of their income, because most of them, it seems like, they kind of have this like very integrated process where they find it, they refine it, and then they sell it, which gets attributed to this downstream line item. So as you can see in this case, it's like around 80% basically over time. And then in this case for Exxon, they also have a chemical division that, provides a small amount of, around 10% of the revenues, which comes from just creating chemicals. Okay, that's a lot of talking. I'm starting to lose my voice. Let's just power through the rest. So that's Exxon. That's the basic structure of it. So I did the same thing for Exxon. I'm not going to go through the details because that would take forever. But is there anything I want to note about this? So I basically followed the exact same structure that I did for Exxon. But here, just to point out how how the equation, the relationship is a bit different. In this case, r squared is actually 77%. So that's actually quite, especially compared to Exxon, right, which was like 42%, that's actually quite good. Where, it seems like this line and this relationship of oil price to EBITDA, the oil price has a very, very strong correlation and relationship to the EBITDA number. So that gives me more confidence, I guess I would say, in this forecast because, this line seems to like fairly well represent what the mapping would look like. So did the same thing, tried to forecast out what the EBITDA would look like, punched in the same numbers using the exact same levels. Oh, I guess just to note, if you want, so in all these cases, I think I just like had the medium set by default. If you want to change the snare that you're using to affect all these different numbers, that's where you can use this drop down. And so yeah, basically the rough structure is mostly still the same. Another thing I point out here, I guess in this case I didn't adjust it. I did for the others, but as you can see, right, how the free cash flow to equity can change quite a lot. Like in the Exxon case, it was like fairly muted, right? It kind of goes up and down, but like it's generally contained to like plus or minus like 20%, 30%. In Chevron's case, it's quite drastic. And so that's something you might want to build into your free cash flow percentage numbers. I did for the other ones. I didn't for this because I didn't spend that much time on Chevron. Because if you look at the eventual valuation that I got, it's actually quite, given the assumptions that I've made, I weighed it slightly heavier to, actually I'll probably weight it more. Let's do 75. Given the assumptions that I've made, the IRR is actually quite low, right? So Exxon was 13%. Chevron is closer to 8%, which is like single digits, which is actually in some ways quite consistent with like the general rhetoric that I've heard around some of the valuations of these companies. A lot of people have been saying, Chevron's a great company and stuff like that, but it is, more richly valued relative to Exxon and then especially relative to some of the European oil majors that we'll talk about next. So I didn't end up spending a lot of time on Chevron because I knew I probably didn't want to explore further, but this is, so it's 8% IRR. Just to illustrate, so yeah, if you changed it right to like low, your R comes down to even 2%, assuming $44 a barrel. And in the high case, assuming $100 per barrel, it looks like the IRR would be 14%. So slightly better. So like basically, right, to compare, that would basically say oil, if you're just comparing across companies, right, oil would have to get to $100 for me to make the same return as if I invested in Exxon for like, and that would only assume I would get 14% only even if oil only got to $60. So just, I guess, something to help you think about like what companies might be more worth it. But yeah, that is Chevron. That is all I want to say about that. Next, let's talk Royal Dutch Shell. So Shell is basically a company, I think it's based out of the Netherlands. Yeah, it's based out of the Netherlands, so they're a European major. What do I want to note about this? It's once again the exact same format. In this case, their R squared is 64%, so not quite as good as Chevron, but definitely better than Exxon. So still pretty decent. It's over 50%, so I'm relatively okay with that. And so what I get in return. Actually, is there anything here I want to point out? I don't think so. Yeah. I think everything here looks... Yeah, okay. So, yeah, take into account, so EBITDA numbers use the same thing. I get a market cap and a share. I get a market cap of just around 250 billion, price per share of $63. And then for looking at my growth rate numbers, as you can see, I did adjust it this time because I did see that, okay, this definitely fluctuates quite a bit more relative to like Exxon, for example. So I tried to like inflate my numbers so that it had more drastic like ups and downs. And in general, like it looks like, yeah, actually, I don't know. Yeah, I can live with this because basically what I do is I try to also compare what does the free cash flow to equity look like per share in the past, and does that seem like, can I see this as like a natural sort of progression with this, and like does that seem fairly natural, and like I feel kind of okay about it. Like we've got a couple of like $10, in here, and it looks like it's gone close to $10 in the past. It does dip down in some cases to like almost close to like nothing, which has kind of been the case before. It's even gone negative before. So in general, like I feel pretty okay about that. So anyway, so when I get the free cash flow forecast, I assume one thing I did do, I guess I did actually no, I just used the average yield. So average free cash flow yield, I get this as my price. I averaged it out slightly. Actually, this is, yeah, no, actually let's go back to 60. So I'll weight it. In this case, I'll just sort of slightly tweak it towards the earnings valuation, and I get back $67 per share as my weighted average. Average price, that gives me an IRR of 24%, which, as we compare, right, to like Exxon versus Chevron, that is much better relative to the other ones, which was 8% for Chevron and around like 14% for Exxon. And this is still, once again, assuming the $60 medium sort of like average case. So in general, that's looking pretty good. As you can see, as of today, the price was just under $40 at $38. And also, if you handily look at the DCF, this actually looks, this is a good sign, right? Where the DCF that I get using the Morningstar weighted average cost of capital of 7.7%. If I run the DCF with that cost of capital as my discount rate, it gives me a current modern day price of $40. So I guess you could say from that margin that like, okay, it's like actually maybe somewhat fairly valued. But yeah, something to take into account. I made a couple of, so once again, looking at the market cap, looks like in this case, Royal Dutch Shell is basically 70% of its average. That's, kind of somewhat consistent with Exxon, I believe. Yeah, actually, no, it's better than Exxon. So Exxon is closer to 80%, and Shell is basically 70%. Were there any interesting notes here that I wanted to call out? Not really. Oh, wait. Yeah, I think maybe just one of the interesting, sort of slightly interesting things about Shell is that they actually have, relative to, I guess some of the other super majors, they have a higher degree of natural gas that they do. Oh, actually, and interestingly, like in their revenue mix, they actually kind of break it out separately. So as you can see, oil is basically 70%, gas is basically 20%, and then they have a very small upstream line of business, and then also a very strong line of chemicals. Just actually as a random just note for those that want a really quick way of getting some of that breakdown, I just discovered this very interesting company that provides all this information, so you don't actually have to search through the 10K for it. So let's say what we're looking at. We're looking at Shell. So they actually handily in their revenue tab actually give you, I guess they probably parse through the 10K and pull this out yourself, but this is basically where I'm pulling it from. Just in case you kind of want a quick resource for that in the future. But yeah, okay, so that is Royal Dutch Shell, and two more. Okay, so BP is another super major. They are based out of the UK, I believe. Once again, did the exact same thing. In this case, their equation is their R squared is only 51%, so it's not great. I already actually took out one outlier because I believe if I left it in, it would make it even lower. Yeah, if I put it in, it would have been 33%. So so it's kind of like cheating, but I figured I wanted something that's a bit more representative. So I took out the outlier. It's around 50%. So not amazing, but okay. So that's the forecast. That's what I'm using to get this forecast. Breaking this out, if I punch it into my forecast, it basically gives me, If I punch it into my forecast, I get $65 a share. Looking at the free cash flow numbers, I once again tweaked this to kind of be more in line with what I saw here. So as you can see in this case, like they actually have gone negative, many more times relative to some of the other companies we looked at. So that's what I try to represent here. Like in the down cycles, I try to make it quite down, so it became negative. And so using the free cash flow equity valuation, I get $125. So I more heavily weight it once again to the EBITDA number because I'm quite not sure. Actually, let me just do 60 because I'm quite not sure. Although I guess it will pump up the price. Actually, let's just make it 70. And so with that, the weighted price I get in 10 years is $83. And that gives me an IRR of 25%. So in this case, I think I just tweaked it, but in this case, 25%, which is kind of the order of like what we saw for Shell. And yeah, and then if I do the discounted cash flow again, I basically get $20, versus right now where it's at $26. The thing to note though about BP that is interesting relative to some of the others is that when it comes to BP, they have been, I think, one of the most vocal like oil companies that have talked about really trying to pivot into getting into renewables. So when it comes to the valuation, there is actually for the other ones, you kind of just assume that, okay, it's going to be very in line with oil prices because they're like, especially in Exxon's case, because I think they're very staunchly like trying to stick the course and stay with oil. So when it comes to BP, this is maybe something where you have to take the valuation with a grain of salt because over time, they really plan on really decreasing the amount that they're going to get from oil and gas and really divesting a lot of their assets there and really investing a lot more of that into renewables, which means that there's a lot of uncertainty about, what some of these future revenues and margins will look like because the makeup of the company is going to, if their plan works out, change quite significantly. I forget if I put details here. So, I don't think I have concrete. Yeah, I don't think I have super concrete breakdowns of like how it's going to shift, but it's pretty sizable. Like for example, right, in 5 years they plan on dedicating 20% of their capex to like renewables and stuff like that. So yeah, that's just something to keep into account when you're looking at this valuation, that you probably want to factor that in if you want this to be as realistic as possible. And so with that, like there's a lot more uncertainty with BP relative to some of the others. And then lastly, we have Total. So Total is another energy company. I believe they're based out of France. And once again, did the exact same thing. In this case, their R squared is 58%. So, okay, kind of average, not amazing. And the other thing to know, actually, so just one last thing, BP. So as you can see, they're on 73% of their market cap. So it's something to keep in mind. And then going back to Total, when we punch in those valuations, we basically get a price per share of $42 in 2030. And then if we do the same free cash flow to equity percentages, I think once again, I was probably too lazy to update this. So is this sort of in line? Oh, this is probably, I would probably, to make this more accurate, probably should make these more drastic. But I am lazy and I'm going to skip past that for now. That gives me if I use the free cash flow equity to equity valuation, that gives me a price per share of nearly $60. And so I definitely weight it more heavily on this side because I was very lazy and did not do this properly on this side. That gives me a weighted price of $46, which is compared to, in 10 years, which is compared to the current price of $48. That gives me an IRR of basically around 5%, which is not amazing. As you can see, kind of unsurprisingly, like if you look at it also, like right now, the market cap of Total is $161 billion relative to the average market cap of 125. And as you can see, it's more than what their average market cap is. I believe this probably is because Total, I believe, has done a bunch of stuff in renewables. So I think they're catching a lot of that like renewable like drift and just like general momentum, which is why I think you're seeing that the valuation numbers do not look as good as some of the others. Okay, that was a lot. I think that's all I want to talk about with this. Okay, so that looks good. What else is on our agenda? Okay, one last thing, just a quick sanity check against Morningstar. So I pulled up basically the reports for Morningstar just to kind of compare with the numbers that I got. So let's say going back to Exxon. I got an IRR of around like 13%. And I came up. So, okay, yeah, there's definitely something kind of strange with my DCF, so I don't know if I count on it too much. But in general, they're basically saying that Exxon is at a 17% discount. Their fair value calculation is around $74. So one thing Morningstar does that's kind of nice is that they actually tell you how they come up with their DCF, they come up with their valuation. So they kind of assume these are the different inputs. Here's what we're assuming the price is going to be. So $60 a barrel, which is kind of consistent with what I used. Here's our cost of equity and cost of capital. They assume that the 2021 Ebitda forecast is going to be around $40 billion. So you can kind of sanity check for yourself, like, do I think that is feasible? I mean, maybe it is, right? Actually, maybe it's not entirely off base. I mean, it feels a bit optimistic to me, honestly, because, I mean, okay, looking at it, I think right now in 2021, where is our chart? In 2021, I believe our current average is $60. Okay, so if we look at it, $60, okay, so like this is probably a good comp to use, but taking into account though the fact that the demand this year is definitely going to be lower than, right, what the demand was pre-COVID when people were still flying around a crap ton. So I don't know, it feels, I will say, a bit optimistic to me, so I don't know if I entirely trust in his fair value, because I don't know if I inherently trust that this forecast is going to be correct. But something just to keep in mind. But yeah, using that valuation, using those numbers, he gets a fair value of $74, which is 17% discount of relative to the current price. Okay, so that's Exxon. Looking at Shell next. Okay, looking at Shell next. Basically, his fair value is $58, which is compared to the current price of just under $40. So with that, that's a 35% discount, but that is taking into account, what does he use as his inputs? He uses, so he once again uses $60 as the medium term. Okay, he uses an EBITDA forecast of, also around $40 billion. Do I think that's feasible? 40. Okay, so maybe in this case, that's maybe more realistic for Shell, because like back in 2019, right, which is our comp from last time, they had an EBITDA of like closer to $60 billion. So I'm more willing to buy that Shell could probably achieve this relative to like Exxon doing it, right, for example. So that's what it looks like for Shell. Then next, this is BP. For BP, looks like their fair value is $30. They are using what for their valuation? He's using just under $29 billion for their 2022 Ebitda forecast. BP. So let's say next year it's like, I don't know, slightly higher than $60. What's a good year to use? Maybe 2018. So 2018, they made $34.5 billion. And okay, yeah, so I can kind of buy this. They're using an EBITDA forecast of $30 billion. But take into account, this is BP, right? So BP, this is where there's like, there's a lot of uncertainty because of that transition shift. And lastly, we have Total. So Total looks like they have their fair value is $57. That's relative to their current price of just under $48, which represents a 16% discount. They are using, in their case, EBITDA forecast of just under $20 billion relative to last year, which is 35 billion. So, okay. I can buy that too. So yeah, I hope this was helpful. I think that's all I wanted to cover today. Um, and yeah, so I guess, you can feel free to take a look for yourself. I will make, as always, some of these charts available so you can kind of tweak and run some of your numbers if you want, and get a sense of what that, what some of these numbers look like for yourself if you want to change some of the variables. And yeah, I hope this was helpful. I'll catch you next time. Bye.